SMEs stand for small and medium enterprise. These are businesses that operate on a smaller scale compared to big corporations. They usually have fewer employees, lower annual sales, and less capital. In Malaysia, SMEs are officially defined based on two main factors, which is the amount of annual sales turnover and number of full employees. This helps a financial institution such as bank to identify which businesses qualify for SME support and financing scheme.
A characteristic means a feature or quality that helps us understand what something is like. So, when we talk about the characteristic of manufacturing SMEs, we are describing the main feature that show how the businesses operate. Let's go to the first point. Production of physical product. Manufacturing SMEs create real tangible goods like clothing, metal parts, furniture, packaging, and more. These are products we can touch, use, or buy in stores. That's what makes them different from service-based businesses. Second, use machine and equipment. Even though these businesses are small, they rely on equipment and tools for production. However, many don't have access to modern or advanced machines. They often use basic tools or manual labor to keep costs low. Third, limited resource and workforce. Most SMEs don't have a large budget, a big team, or extra material. They often operate with fewer than 200 employees and limited capital. This can make it hard to expand or compete with bigger companies. Fourth, flexibility and quick decision making. They are flexible and quick to adapt. One advantage of being small is flexibility. SMEs can respond quickly to change, like customer needs, product demand, or supply problem. They don't need to go through a layer of approval to make decisions. Fifth, they are locally owned by community-based. Most manufacturing SMEs are started by individuals and families. They are rooted in the local community, providing jobs and supporting the local economy. They usually sell products to nearby customers and small retailers.
Here are some examples of manufacturing SMEs in Malaysia. First, we have electronics and electrical manufacturing factories, which produce components like wires, batteries, and home appliances. Next is the automobile manufacturing sector, where SMEs may focus on core parts like seats, tires, or electronic systems. Then, we have food and beverage factories, such as those producing snacks, bottled drinks, or frozen foods. Lastly, furniture manufacturing factories, which make items like tables, chairs, and cabinets, often using local materials. All these sectors show how diverse the manufacturing SME industry is in supporting Malaysia's economy. I will be sharing the role of manufacturing SMEs in Malaysia. First and foremost, they play a big role in job creation, especially in rural and semi-urban areas. This helps reduce unemployment and support local economies. Furthermore, manufacturing SMEs act as suppliers to bigger companies, especially in sectors like electronics, food, and textiles. They help complete the industrial supply chain. Next, they contribute to exports, producing goods that are sold internationally and earning foreign income for the country. In addition, many of these SMEs support innovation using automation and technology to stay competitive and improve product quality. Last but not least, they help achieve national goals under the SME Master Plan and Industry 4WRD policies. In conclusion, manufacturing SMEs support jobs, exports, innovation, and Malaysia's economic growth.
Next, let's move to the reason that lead to the difficulties and obstacles faced by SMEs in securing bank credit. First, many SMEs often lack sufficient asset that they can offer to bank as collateral. Collateral is important because it gives the bank security. If the borrower cannot repay the loan, the bank can use the collateral to recover the money. However, a lot of manufacturing SMEs operate using this machinery to work from rented premises. These assets are not owned by the business, so they cannot be used as collateral. This puts the SME in a difficult position, especially when they need funding to buy a new equipment or expand production. Without suitable collateral, banks are less confident to approve the loan. In addition to that, many SME, especially new or smaller one, have limited credit history. That means they haven't borrowed before or they don't have a strong record of repaying loans. Without this track record, banks consider them high-risk borrowers. Even if the business is performing well, the bank may still be hesitant.
Another major challenge faced by SMEs in getting bank credit is when the business is simply too young. New businesses, especially those less than 2 years old, are often seen as high risk by banks. This is because they haven't yet proven that they can survive in the market, and they usually lack a financial track record. Banks typically prefer lending to companies with at least 2 to 3 years operating history. Banks typically prefer lending to companies with at least 2 to 3 years of operating history. This allows them to analyze the business income stability, profitability, and how well it can handle cash flow. Without this record, banks can be confident that the business will be able to repay the loan. Also, younger businesses often require stronger management skills to grow and stabilize, especially in small organizations where the owner wears many hats. Without these competencies, the risk of businesses failure become higher, which is why banks are extra cautious. So, in short, the younger the businesses, the harder it is to get funding from traditional banks because of perceived uncertainty and high failure rate.
Lastly, weak financial record and documentation is also one of the reasons that lead to the difficulties and obstacles faced by SMEs in securing bank credit. It is because some SMEs operate mainly in cash-based economy, especially in formal or micro enterprise, especially in informal or micro enterprise segment. Some SME owners, especially in rural areas, may not have easy access to bank or digital payment infrastructure. Also, not all customers use wallet or credit card, so cash is the most practical option. Second, some SMEs intentionally keep incomplete records to avoid taxes and regulatory scrutiny. Some SMEs may operate without a proper business license. They also might hire an undocumented worker so they can sell their goods without declaring them. An incomplete record also could help them to hide these activities. For the third reason, SMEs may not be able to afford to pay a professional accountant or bookkeeper. Many SMEs operate on tight budget, especially in the early stage. Their revenue is often just enough to cover their raw material or inventory, rent and utilities, wages, and their daily operation. Hiring a professional accountant can be too costly compared to their income.
To conclude, SMEs are very important for a country economy. They help create jobs, encourage entrepreneurship, and support local communities. Because they are small and flexible, they can easily adjust to changes in the market. However, SMEs also face some problems. Many of them doesn't have enough access to money, skilled workers, or technology. They may also find it hard to deal with government rules or compete with bigger companies. To help SMEs grow and succeed, government and institutions need to support them. This includes offering better access to loan, training program, and easier business rules. When SMEs are supported, they can help reduce poverty, grow the economy, and create a more stable society.